At the end of March, Q1, the bank took a provision of $5.2 million due to COVID-19 with anticipated losses based on the CECL guidelines. We also know roughly 62%, based on your results in the report from Piper, that 62% of Butterfield loans are residential. Do you anticipate having to greatly increase provisions? Is that something you can discuss?
We monitor, as you can imagine, our loan portfolio very closely. Unlike the last financial crisis the island experienced, the credit portfolio going into COVID-19 was really in excellent shape. Our non-performing loans, our delinquency rates are all very low, single digits. So we start from a good place, and we start from that place because of conservative underwriting standards in terms of loan to values and debt service coverage. So while it would be very reasonable to expect eventually, as the crisis carries on, we do expect there'll be issues in the mortgage portfolio, but frankly, we expect them to be quite manageable given the overall quality of what the book was in going into the crisis. We have, recognizing really early on that this crisis was going to be severe and people were going to need aid. We put in the loan deferment for mortgages, personal loans, credit cards. The first phase of that expires the end of June. We are already talking about in what form we're going to extend that, and I do believe we will be extending it in some form. And that's, again, designed to get relief to the people who need it most. And our larger loans to companies, and particularly the hospitality sector, we're in regular conversation with them and getting things structured so there's a mutually agreeable, viable solution both for them and for the bank. So I think having not gotten over our skis in terms of the extension of credit going into the crisis as opposed to where we were in the last crisis has really positioned us well to weather this storm as a bank.